Hello and welcome. In this session, you're going to look at the interpretation of statement of cash flow. Now, in our previous session, we have seen how to prepare the cash flow statement. And now we're going to look at how to interpret it. It's very important to understand the meaning of the cash flow and how to explain. Most of the time, obviously, in the exam, the question will ask you both. They'll ask you to calculate the cash flow statement, or sometimes they can ask you individually. For example, they can ask you the cash flow from operating activities. They will give you the data that is relevant only for the cash flow from operating activities, or they can ask you from financing or investing activities. And on top of that, they'll ask you the meaning of that. So after looking at the cash flow statement, you have to give some comment, you have to analyze it, and you have to tell what exactly happened to the company. Sometimes it is possible they can ask you for the recommendation. So company is doing well or not, and what company can do to make it better. So looking at in this area in this session. Now, the first thing we are looking at the exam focus point. Anytime if you're looking at this box on the book, make sure you read it because that is the area the examiner like to focus on for the student. So here it says, recent examiner report have consistently stated that subject do not perform well in the section C interpretation question. That means most of the student, they do not perform well in the interpretation. That means they know how to calculate the cash flow, they know how to prepare the cash flow statement, but they don't know how to explain it. Mainly due to not addressing the requirements or not using the information in the scenario to explain ratios calculated or changes in the financial statement. This point extends to interpretation of the statement of cash flows. You must understand each situation or each section of the statement of cash flow represent. But in making generic statements above, for example, what the cash flow from operating activities section shows will not score credit in the exam. You must make more specific point based on the scenario you are presented with. Very important thing here. So the first thing they are trying to tell so many students, they don't know how to answer good, so not perform well, number one. Number two is, what is the main reason behind? Not addressing the requirement. So they do not read the requirement correctly. So they just write whatever they knows. And also another point, the examiner mentioned that here, sometimes they just write how much is the cash flow from operating activities or finance activities. They just give the number. For example, from the operating activities, if the cash flow shows 200,000 is a positive, so they write cash flow shows 200,000 positive. But this one will not score any credit in the exam because when you explain, you have to say something that you didn't say yet. For example, if I just say the cash flow from operating activities is 200,000 and it doesn't mean anything, I have to explain in detail. In details means why there is a positive, what is the reason behind of this positive cash flow, and what is the implication of that. So I have to explain in detail, not just simply say it like cash flow have a positive or negative impact on the operating activities. It will not give any marks in the exam. So you must make more specific point based on the scenario you are presented with. So you need to make sure you read the scenario and you try to focus it on. All right, let's looking at a little bit now how it work before we go one question and we do it together. So we have three areas. The first one is the operating activities. Now, operating activities mainly link with the company's profit and loss account. So when you're looking at the company's profit and loss account or the P&L account or income and expenditure account, there we are looking at the information and that is more relevant to the operating activities. Normally, the company should have a positive figure. So that means the cash flow from operating activity should have a positive impact. There should be a positive balance, even though the cash flow from the financing activities and from the investing activities, it is possible there could be a minus or negative number. But for the operating activities, most likely or should be positive number. The reason is if the business don't have a positive number on the operating activities, that means the business are struggling to survive. And there'll be question for the going concern. There'll be question for the sustainability for the business. Because if the business don't have enough working capital to run the business on daily basis, that means they're on risk. So you need to be very careful with operating activities. And even in the exam, if you see the operating activity showing the negative number, you have to be very careful to double check like why it is negative. There is a possibility you might make a mistake on the calculation. So you have to be very careful on that. Now, when we have a positive for the operating activities, as long as you see the positive number, we have a, let's say, 5 million positive from the operating activity. It doesn't mean the business is doing really well. We need to know why there is a positive. It is possible the business can sell some non-current asset during the year. For example, the business sells some property or business sells some land and they make a profit. Now, when they make a profit, this profit become the part of the profit and loss account. And for that reason, what happened? The profit and loss account shows more balances. For example, if the company been making a loss £100, but because of selling a land or a property, they make a profit £500. So this £100 will be offset against the £500, and then net profit will be £400. For that reason, we have to be very careful, even if we have a positive figure, what is the reason behind it? Now, when you have operating activities, of course, we are looking at only cash flow statement. Now, there is a very good relation with the profit and the cash flow. Most of the time, if the business have a consistency or if the business is healthy, that means the business is doing really well and how much they're making the sales, they are getting this money back from the customer on time or they're paying to the supplier on time. So there should not be a huge difference between the profit we show on the profit and loss account and also how much cash we have on the bank. So there should be a balancing figure there. It's not going to be huge difference. Only if there's something happen, like for example, we sell our non-current asset or something, because it's not going to happen every year. For example, if the business sells some asset this year, like a fixed asset, but not necessarily business can sell the same asset next year to have some more profit. Needs to be very careful. And of course, we know when you prepare the profit and loss account, we prepare based on the accrual concept. And the accrual concept tell us, even though the transaction is not paid or received yet, still we need to record it. That means it is possible there is a lot of credit sales happen during the year. And for that reason, the profit and loss account showing a lot of profit, but actually none of the customer paid yet. And for that reason, there is no cash came into the business. Now, we cannot say is it good or bad because it is possible sometimes when the credit term increase and the profit is increased. Is it good? Maybe for the time being, the cash didn't receive, but very soon the cash will receive by the business. Or it is possible you receive a lot of money from the customer, you don't have that much outstanding balance because your customer is declining. So for example, last year, your outstanding customer was 200,000 and this year the outstanding customer trade receivables is 100,000. So it's look like it's better you collecting the money from the credit customer. But it could be on the other hand, it is possible like the customer is declining, so you don't have much customer now. That's why you're receiving more money. So you need to be very careful with that. And the next point, normally going to talk about the operating activities, that is the working capital changes. So three things we consider on the working capital changes. We're looking at the trade receivables, we're looking at the inventory and the payable. Again, increasing or decreasing, always we cannot say good or bad because it is possible we have some supplier and we paid on time, or maybe we don't have any money to pay, so we take more time. So it shows like the trade receivables is getting better, but not necessary. It could be the main reason. So let's quickly have a look at this one. So this cash flow from operating activities figure should ideally be positive. Should ideally be positive because no one do the business for making the loss. If the business at least uh, cover some cost and have enough cash flow to pay the daily basis expenses, so they should have a positive balances, because this one is the this is all the money I have from operation. For example, if I sell some pen, if my business of selling the pen, so if my pen cost is £10, so I should sell it more than £10 because I don't do the business to make a loss. So if I can cover my operating activities, of course, like I should have a positive figure. If it is positive, then the business will be generating fund from its core activities. Core activities means the daily operation. We suggested that it is more likely to be a viable entity. Viable means it's like it looks good. That means like it's nothing fluctuate very much. The quality of profit it considered to be better. Now the quality represent there is nothing there is a window dressing, or nothing there is a made up figure. It's like a real figure, it's a solid amount. The quality of profit is considered to be better in that profit will turn into cash in the short term. That means if I make a profit, that means very soon the profit will be turned into the cash. For example, if I have a 3 customer ABC, and if I make a sales 1000 to each customer, so that means I'm expecting very soon this 3000 will come to me because I make a sale. So I don't expect like the customer will return or they'll never pay. In healthy business, the customer always pay. So that means even though £3,000, for example, I'm showing you the trade receivables, but in a month, this 3000 will be converted into cash because all these people pay to me. Even for the time being, there is no cash, but very soon there will be cash. Then it says, a healthy business would also expect to pay interest and tax charged from the cash generated from operation. That is very important because if we show we have a lot of profit and actually we don't have any cash on the bank, so we will not be able to pay the interest to the bank and will not be able to pay the tax to HMRC. So we should have enough money on the bank to pay the tax and the interest. But if we have a lot of outstanding credit customer, and if the customer take a long time to pay, it is possible we are making a profit from the business, but we don't have cash because customer taking ages to pay, or maybe we are taking less time to pay the payables to the supplier. So for that reason, the working capital is not very good and we don't have enough money to pay the interest and the tax. But if the business is healthy, we're expecting we should have enough money on the bank account to pay the interest and the tax. Any cash inflow that will remain after the payment of the interest and tax is considered free cash. Now, free cash means like the government said, for example, we say PBIT. That means profit before interest and tax. Let's say profit before interest and tax is 5,000. Then we minus the interest because interest is allowable expense. So let's say interest is 1,000. Then we have 4,000 left. We call it PBT, profit before tax. And then you minus the tax. For example, the tax is 1,000. And we have a 3,000 left. And this one we called it PAT, profit after tax. Now this one we called it free cash. Free cash. Why we called it free cash? Because this cash actually can be used for any purpose, the way business like. For example, if the business like to pay some dividend, they can pay from here, dividend. If the business think I'm not going to pay the dividend this year because I want to expand the business, I want to make it bigger, or I have a plan to make a new branch. So if they have any plan, they can use this money because rest of the money, it will go to the RE, written earnings. After paying the tax, any money left It goes to the retained earnings. And from there, we pay the dividend. So this is the free cash business can use for any purpose. That what they're trying to say here. So free cash, which can be used, for example, purchase of the property, plant equipment, or pay the dividend. They can do actually whatever they like. It's up to the business, it's the free cash. When you are analyzing the cash flow relating to operating activities, it is important to consider the movements in working capital. Now, we already know the movement is the combination of three things. So you have a trade receivables, we have a trade payable, and inventory. Now, this two is very much linked because the way of we do the treatment, we do the same way. So if the trade receivables is decreasing, normally there is a cash inflow. For example, in 2001, let's say 2002. Now, if we have a trade receivables in 2001 is 2,000 pound, and in 2002 is 1,000 pound, so it's decrease. So from 2001 to 2002 is a decrease by 1,000. That means we have a cash inflow 1,000. It is decreasing means the customer paid to me. And it's look like it's good. But as I said before, we cannot say it's good unless you find some more reason. What is the more reason? The more reason here is why the customer balance going down. Now, if this is because I'm declining the customer, last year I had a lot of customer, that this year I am losing my customer, then we cannot say it's good. Even the money is in, we cannot say it's good for the business. Same for the inventory. So if the inventory is going down, that means I sold a lot of inventory, but it is not necessary always. It is possible I'm not buying the inventory anymore. For that reason, I have a less. So if this is the cost, it is not the good reason. Same for the trade payable. If the trade payable days or trade payable is increased, so I took now more time to pay my supplier. But what is the reason behind? Is it because I don't have money to pay? If this is the reason, it's not a good reason. So if you're looking at the trade receivables, it says an increase in trade receivables may result cash flow problem. If it is increased, it could create a cash flow problem. So if it decreases, good, increase cash flow problem because customer taking more time. Consider whether there are genuine reason for the increase in trade receivables that may help to explain an increase, such as taking on a major new customer on extended credit term. So it is possible like you find a very good customer or big customer. For that reason, the extended credit term is given. For example, you don't want to lose that customer and you give a lot of benefit. And one of the benefit is like you telling customer, listen, all of my customer, they pay in 30 days, but I am giving you 60 days. You can pay in 60 days. And that's why the outstanding balance is more, trade receivables increase. It is possible. In this case, it could be a good thing. A decrease in trade receivables is favorable. Even this look like favorable, the example we just saw here, if it is the result of a better credit management, but not if it is a result of decreased amount of the revenue. So if my sales is going down, and because of this reason, if my trade receivable is going down, it cannot be a good reason. Same thing for the inventories. An increase in inventory is also generally a problem in terms of cash flow, but again, consider whether there is a specific reason for this, such as bulk buying close to the year end or take advantage of discount offered by the supplier. Now, if you see the inventory is going up suddenly, so you are thinking like there is a lot of cash outflow because I buy the inventory. But what is the reason behind? It is possible the supplier said, if you buy that much of quantity, I'll give you a very good discount. And for that reason, maybe you buy. Or maybe there is some bulk discount or some other discount offered by the supplier, and that's why you buy a lot at the same time. Or it is possible you're expecting a big order very soon, and for that reason you don't want to running out of the stock. Or sometimes it's possible there's a risk in few months this stock or the inventory will be out of stock or the raw material, and for that reason you buy it. So if this is the reason, it could be good reason as well. But from the cash flow point of view, it will show you the not favorable, so it will show you the adverse, but doesn't mean it's always bad. At the same time, we have a trade payable that, as I discussed before, an increase in trade payable is positive from a cash flow perspective. If it is increase, it is possible from the cash flow perspective, but the reason must be understood. For example, if an entity is simply taking the advantage supply credit term, it makes sense from a working capital perspective to increase the payable. However, if increase is due to poor working capital or lack of cash, for example, if I call my supplier and if I tell them, listen, I don't have money to pay you, and if this is the reason they give us some more time, this is not a good reason. So you cannot say it's favorable. So you need to be very careful and know in detail. So this is the main area we have to be focused for the operating activities when you're going to analyze any company financial position from the cash flow point of view. The next one, you're going to looking at the investing activities and the financing activities. Don't have much thing here. So investing activities. So here we are looking at how much money you have invested. Now, of course, like when we invest it, this is possible. We can buy the fixed asset. Investing is not only the investment. Investing represent any money that I invested for the long term in the business. For example, I can invest in the PPE, property, plant, equipment. I can build a factory. I can build a plant and equipment. For any reason, if I buy any fixed asset for the long run and invest in the business, that will come to the investing activities. And investing activities always normally is outflow, because if I invest the money to somewhere, it should be outflow, cash outflow. But at the same time, it is possible we can dispose. So for example, we sold some asset. So it is possible we dispose or make a disposal of the PPE. For that reason, the cash will be inflow because we made a disposal. When you make a disposal, there will be always linked with the operating activities. Why? Because the disposal always comes with the either profit or loss. When you sell a non-current asset, we take the whole amount in the investing activities. But if we make any profit or loss, that will be linked to our operating activities. Because if we make a profit on disposal of the non-current asset, we have to take away from the cash flow operating activities. So you need to be very careful. Also, it is possible one company can invest to another company. For example, Tesco invested some money on Asda. So if Tesco invested 1 million to Asda, that means Tesco buy 1 million pound share from Asda. So Asda has to give some dividend to Tesco. So if we receive the dividend, remember it will be part of the investing activities. Let's quickly have a look. Its analysis of investing activities rely on an outstanding of an entity business model and the aim. If the business is seeking growth, there may be a net cash used in the investing activities to reflect the amount spent on, for example, the purchase of property, plant, equipment, intangible asset, or investment. If the business has a lack of cash, it may resort to selling the property, plant, and equipment in order to generate some short-term cash inflow. Investment income will also be recorded in this section, and therefore interest received or dividend received may feature here. So it is possible if I give a loan to someone, I can receive the interest or I can receive the dividend. So either I receive the interest or dividend, it will be part of the investing activities. Finally, the financing activities. Here we are looking at the new share issue. See if the company like to raise some money from the market. So looking at the share issue, so ordinary share capital, it could increase. And also if we paid some dividend, because if someone invests on our company, we have to pay some dividend. We need to record it here as well. And top of that, if anything that is relevant with the long-term finance, for example, the loan or the payment for any long-term liability that will be linked with the financing activities. Let's quickly have a look. It's again, to understand the cash flow from or used in financing activities require an understanding of an entity challenges and aim. An entity that is growing and investing in asset may require to raise cash flow by issuing a new share or receiving loan from the bank. So either new share or loan received from the bank that will be relevant to the financing activities. While the cash inflow from the proceeds of the financing are positive in the year they are received, you should reflect on the impact on entity of having to pay interest and make capital repayments in the long term. So either I take a loan or make a repayment for that, we need to record it on the financing activities. An entity that has acquired right use asset, this one through the lease. So it is possible sometimes the business, rather than they buy the asset, what they do, they take the lease for 100 years or 200 years. Sometimes it's very common. For example, even if the business have a building, they own it, but they need some money. So what they do, they sell it and take the lease immediately. So it's called like sale and lease back. Sell and lease back is very common. Sell and lease back. Even we see like in Canary Wharf, we have a head office for the HSBC, and they did the same thing. So they sold the whole building for few millions pound, and after that they take the lease back. So lease back. So what happened? When they sell, they get one-off money from the buyer. And after that, they take the lease for 100 years and they pay the yearly premium or the rent so that they can still use the building. But at the same time, they generate a lot of money by selling the building. So if we have this one, an entity that has a accurate right of use asset through lease agreement rather than purchase asset using cash will have an outflow in respect of the payment of lease obligation. So if we have a lease, we have to pay the lease obligation, and that will be in the liability section on our balance sheet until the full payment is made. An entity with a surplus cash may use it to pay back borrowing. So if the company have a surplus or extra cash, they can pay back the loan if they want. So this is all about the financing activities. All right, the next one we have here is the relationship between the profit and cash. Now, so far we understand it very well. Whatever profit we have on the profit and loss account, based on the accrual concept, it is not necessary the cash flow will be matched with that. But if the business is healthy, most likely the figure will be very close. It's not going to be very much upside down, so it's not going to be not very big difference, because when we have a profit from the operating activities, it's look like this profit will be turned into cash very soon. But obviously, few things always we adjust on our profit and loss account. For example, for the accruals, for the prepayment, and for the provision, this sort of thing that we adjust on our profit and loss account because we paid either in advance or we have used the services that we need to pay in future. And this sort of thing basically can create some short-term difference between the profit we reported on the profit and loss account and on the cash flow statement. But in the long run, when company try to look at their situation, how the company doing, they cannot just do for 1 year. They have to do it for a longer than one period. For example, if company want to see how they are doing from the point of view of cash flow, so they have to look at least last 5 years cash flow statement and last 5 years profit and loss account, because so many transactions that happening this year is basically linked to the last year. For example, if we have a provision, so if we have a liability that we have created 2 or 3 years before, but we are paying now, So it's not relevant to this year. For example, if we have a income tax, for example, if we pay income tax this year, this tax is not relevant to this year. For example, even the company making a loss this year, but it's still company paying a lot of income tax. Why? Because this tax relevant to the last year, because company pay the tax after a year. So what we see on the cash flow statement, sometimes it is not all linked for this year profit and loss account. And looking at just 1 year financial statement and the cash flow will not be able to compare and will not be able to give a decision. So you have to look at for the long run. All right, so let's have a look quickly. It says relationship between the profit and the cash. It is important to appreciate that it is wrong to try to assess the health of a reporting entity solely on the basis of single indicator. We cannot just decide based on the single indicator. We cannot just looking at only one indicator and we take a decision it is right or wrong, because there could be other matter involved. When analyzing cash flow data, the comparison should not just be between cash flow and the profit, but also between the cash flow over a period of time, say 3 to 5 years. So this is one we're trying to say. We cannot just compare for 1 year because it will never give us a right figure. And that's all they explain here. In the bottom, they said profit is not important. Profit is not as important as extent to which a company can convert its profit into cash on a continuous basis. So if you have a profit and if this profit never converted into cash, it's not helpful for the business. This process should be judged over a period longer than 1 year that we have discussed. This cash flow should be compared with the profit over the same period to decide how successfully the reporting entity has converted earning into cash. That means, for example, if I pay a tax £1 million, or if I pay a provision for any obligation this year £1 million, so this £2 million is not relevant for this year. So I will not consider when I will compare my profit and the cash flow, I'm not going to consider this 2 million that I paid from the bank because this belongs to the last year, not from this year. It's very important to understand it better way, just not looking at one single indicator and we give the opinion. It's not going to work. All right. Now we're going to look at one cash flow statement, one example, and we try to see how to interpret their cash flow statement. Now, to prepare a cash flow statement, we know we need a financial statement, and the financial statement is the combination of the balance sheet. And to the balance sheet, you called it a statement of financial position or SOFP. And of course, we need the profit and loss account. Now, sometimes it is possible the question might not give you the whole P&L account or profit and loss account. They can give you just profit before tax and the tax information and the interest, because that's all you need. Maybe they don't want you to give a big profit and loss account like rent, rates, advertising, because that's irrelevant for you anyway. The relevant factor from the financial statement, we're looking at the profit on disposal on the non-current asset. If we have sold any non-current asset, is there any profit made? So that will be relevant. The next thing will be relevant, like how much tax or interest we paid during the year. It is important. And also you need to looking at, is there any notes? Normally in the exam, they'll give you the note, the additional information, and you have to read this note very carefully and you have to relate it when you're going to explain it. Now, when they ask you to explain it, that means the cash flow statement is already done. When I'm going to interpret the cash flow statement, that means the cash flow is already completed. Either they'll ask you to complete the cash flow statement, then to interpret, or they'll give you the cash flow statement just to ask you to interpret. So it could be both. All right, let's look at this one. It says, here is an example. We have TICO. Here is an example of how the position and the performance of a company can be analyzed using the statement of financial position, profit and loss extract, and the statement of cash flow. The following draft financial statements relate to TICO, a private company. statement of financial position. So we are looking at the balance sheet now. So we have a PPE, property, plant, equipment. So we can see last year we have 15,800 and this year 10,600. So it's going down. When the PPE is going down, immediately we understand we sold some PPE. And if we sold, what happened? There might be a profit or loss. And if it is increase, it will be opposite. That means we have purchased the PPE that's relevant to the investing activities. So you need to be very careful. Every single thing when you read, our mind should work immediately like what's happening here. So if it is decrease from 15,800 to 10,600, that means is reduce my total asset, and only the reason my total asset could be decreased or reduced because I sold it. And when I sold something, there's always some profit or loss involved, because when I sell something, either I sell it less than my cost price or more than my cost price. So when I say cost price, that means like the cost minus the depreciation, I mean the net book value. You know how to do it anyway. So this is the first thing, consideration. In the exam, even when you read this type of question, immediately you make a note for that. So as soon as you see it's going down, make a note like PPE is going down by this, that means disposal, so you don't forget it later on. The next point we have here, we're looking at the current asset, and we know the current asset is important because here we're looking at the changes of the working capital. So here we have the inventories. So inventories is increase. If it is increase, we know it is outflow because we have purchased more inventory. But remember, we cannot say it is bad because we paid some cash to buy the inventory, because it is possible we might get some discount from the supplier, or we have a big order coming soon, so that's why we buy a lot of inventory. Or it is possible the customer give us very good offer, that's why I buy. So it is not necessary we have a cash outflow and we say it is not good. You cannot say that. Trade receivables again increase. It's not very good. Now it's look like the cash outflow, and obviously like that means more credit customer is like increase the balance. Now it's not necessary like, oh, the people are not paying. It is possible my total sales also increase. So if I'm looking at the revenue figure, I can look at that. But it is possible in the question, they might not give you the sales for the last 2 years. They might just give you the sales for current year, so that you cannot compare. You cannot say like, oh, my sales is increased, that's why my trade receivables increase at the same time. But they might not give you the sales for both year. In this case, you have to be careful. You have to use the word maybe. So if you use the word maybe, you will get the full marks for that. So we have the inventories increase, trade receivables increase, and we have some insurance, cash and cash equivalent. So we had no cash on last year, it was nil. This year we have 850. And then we have some equity section, share capital. No new share is issued. We can see here we have 6,000. So we don't have to worry about the share capital. And then revaluation surplus. Before it was 1,600, and now I have nil. So written earnings 850 and 2250. Again, the written earnings could be linked with the dividend, but we need to know more information. For example, the written earnings before what it was 850. Normally with the written earnings, if there is a profit, the written earnings will increase. So if there is a profit, we add the profit and we minus the dividend to find the closing balance. But here we can see the written earnings is increase. So don't think so they paid any dividend, but we can always double check. Non-current liability. So lease liability is increase from 1,700 to 2,000. Loan note. So this is very important because loan notes linked to the financing activities. And we can see here 6% loan notes we never had before, and we just took now. So it's inflow by 800. Now, sometimes is you can say is a good thing. Why? Because before the company have a loan note for 10%, the interest was 10%. how much they had before, 4,000, and now they have a nil. That means they paid everything. They paid all this £4,000 loan, and then they took the new one that is 6%. Why? Because of course, like they don't want to pay the 10% interest if they have an offer for 6%. So that's why they took the new loan that is 6% and they paid off the old one. So they make it nil and take the new one. So this looks good. Deferred tax, so it was 500 and now it's 200. So deferred tax is created for a temporary period because of the timing difference. So there is nothing much to do with the cash flow anyway. Government grant. Now, even though the government grant is not relevant for the cash flow, but it could have some impact. Because when when government give any grant to a company, for example, if the government offers some money, the government always gives some terms and condition. The government always give the money with some terms and condition. For example, the grant is something is like a gift from the government and you don't have to pay it back. So for example, the government said like there is a place in Liverpool and there people are not living. So you want to create a community there. So if you like to live there, how much is the house price? The government will subsidize by 70%. So the government will pay for you 70%. Or, for example, you will get more benefit. You don't have to pay for your car, don't have to pay for the travels. The government give you some benefit. Or, for example, you want to make a factory, you want to create some job, and the government said, okay, if you want to make a factory there because that will create a lot of job, we'll give you like £1 million as a grant. So this sort of thing obviously always comes with the terms and condition because after taking the money from the government, if you don't fulfill your target, if you don't do the job that you wanted to do or what you said to the government, then you might need to give the money back. This always happen during the COVID time. It's happened. A lot of company they took the grant from the government saying they will do this, and after that they never done anything. Obviously, like the government asks this money back because if you give a commitment to the government you want to do something, and if you don't do it you have to give this money back. So the government grant can be a little bit obligation for the business if the business don't follow the terms and condition. Then we have a overdraft. So we can see that the overdraft is fully paid. There's no more overdraft this year. Is it good? It's most likely the business sold some asset. That one we said before, like the non-current asset is going down from 15 to 10. That means all the money they received by selling the property, plant, equipment, they paid the loan, they paid the overdraft, just surplus cash they used to pay all the liabilities. Trade payable also increase. Trade payable also increase. Now, in a sense, from the cash flow point of view, it looks like good because now we are taking more time to pay our supplier. But on the other hand, as we discussed before, it might not be good because maybe we tell our supplier we don't have any money, so the supplier offer us more time to pay it. So if this is the case, it cannot be good for the business. Then we have some more government grant on the liability. So sometimes the government grant can come as a liability as well that we have to pay back. So if this is the case, we need to show it on the balance sheet as a current liability. So this money has to pay back to the government within a year. Then you have a lease liability. So increase from 800 to 900, and the tax payable. Now you can see the last year the tax amount was 1200, the liability this year 100. So it's looked like a very clear that the last year the profit was more, because if the profit is more then we pay more tax. So this year we have only £100 tax. That means my profit also less this year. But again, remember that it will have impact on our cash flow. Why? Because the last year tax we are about to pay in this year. So that's why. All right, so let's have a look what else we have. And now we have our profit and loss account. As I said before, it is possible the company the question can give you the profit and loss account only for the current year. They might not give you the profit and loss account for the last year, so you might not compare like the sales is increased or not. Operating profit before tax and interest, so this is PBIT, that is 270, and the interest expense is 260, then interest receivable 40, profit before tax 50, income tax credit 50. Now income tax credit is something that you're getting back rather than you paying. You have a credit. Now credit means like the way we have a credit on our phone, so we have already some balance there. This shows profit for the year 100. All right. Then statement of cash flow for the year ended 30 September 2015. So let's have a look. So this is the cash flow they are prepared. And start with the profit before tax. That's always we start with PBT, profit before tax. And so far we know how to prepare the cash flow. So you can see profit before tax 50, then depreciation will add back because it is a non-cash item. And then we can see the disposal of PPE. So it's very important to remember that. So the profit was good because this profit was added. So almost 4.6 million, 4.6 million was added on the P&L account. And that's why the profit looks very good on the profit and loss account. But on the cash flow, we're going to take it out because this profit is not belongs from the operating activities. This profit is not belongs to the business operation. This profit came by selling the non-current asset, that is PPE. So what business doing? The main activities is not selling the non-current asset. For that reason, we need to take it out. We know why we do it because this is not the business activity. That's not the business do every day. So if they sell a non-current asset this year, it doesn't mean they'll sell next year again. So we want to see how much actual profit came from the business operation. So we minus it and release the grant, then insurance, then interest expense. We added back because we always do it twice. So interest expense, first we added back and after that we paid. Okay, so this is our information we have, and after that we have working capital changes. So increase, decrease, and cash used in the operation. This is very important. So how much cash we used in the operation, that means how much cash we used on our operating activities, that is 2.78 million. So 2780, 2780 we have used on the business in the operation after adjusting everything. So if something is not relevant, we have to adjust it. So depreciation and back, profit on disposal, we need to take away, release of grant, take away, insurance claim receivables, take away, interest expense, add back, investment income, minus. Investment income is relevant to the investment activities, is not relevant here. So we need to minus it. All right. Then after we minus the interest and the income tax paid. So once we have all this information, now we know net cash outflow from operating activities is 4390. Now it's very important. If you remember, we have discussed if the cash flow from operating activities is showing negative, that's very dangerous. It's very risky for the business because the business must have or should have the positive figure from the operating activities. If the business don't have it, that means the business is not a healthy business. Business is in risk because business cannot just depend on this 4.6 million that they make the profit by selling the non-current asset, because it's not going to work for the long run. It's just not their job to sell the non-current asset. Then we have a investing activities. So this 40 that we receive is come here again, the received of interest, and of course like that is very important, like to understand or remember the format. Then we have here the proceed of grant. So how much new grant came, the proceed of disposal of the property, that should be on our note. So 12,000. So you can see here on the additional information, they say T company sold this factory, fair value 12 million on 30 September 15, and the transaction met the criteria IFRS 15. Under the term of sale, TCO will immediately lease the factory back for 10 years. So that means it's sell and lease back. So they are selling it and after that taking it back. The accountant of the tea company has de-recognized the factory and has recorded the gain on sale in profit and loss. So basically, they show it on the profit and loss account, and they have not accounted for the lease. Some of the proceeds were used to make a loan payment, which was overdue. So they said the money they received by selling 12 million, they use this money to pay some loan and some overdue amount. And also, they have not accounted for the lease. So normally when you take a lease, and if it is more than 5 years, it is a long-term lease and we have to show it on the financial statement. Anyway, so then the next one we have here, net cash from investing activities. It looks like it is a positive. Why it is positive? Because of selling this one, because of the disposal of PPE. That's why it's showing the positive overall. Then we have a financing activities. So on the financing activities, we have proceed of loan, 6% loan received, 800, repayment of loan, 10%, 4,000, and the payment under the lease 1,100. So this is the new loan we have taken. There's the 4,000 we paid, the long-term loan. And the lease payment we have here 1,100. That shows us the net cash used in the financing activities 4,000, 4,300. So now if we added all this thing, so if we just find the total balance, so we have from the operating activities 4,390. Then we add this one, the investing, and then we minus 4,300, and that will give us 1,400. That is net cash, net increase in cash and the cash equivalent. And we have opening cash and cash equivalent 550, and that will give us the closing balance 850. So this is the cash flow they made based on the financial statement that on the above. So you can see here. So you have opening balance 550 overdraft. That's why it's minus, because we don't have any cash last year. If you remember, the cash and cash equivalent, we had nil. So we had only overdraft 550. And that's the reason we took it as a minus. So 550 minus. The closing balance 850. If you look at the financial statement, it should show you the balance 850. So the cash flow is matched, is balanced. Anyway, now we're going to look at the additional information. Then you're going to look at how to interpret it. So the first one we have just discussed. The next one is says property, plant, and equipment include plant acquired under the lease contract entered into during the year which give rise to the right of use asset 1.5 million. The initial measurement of the right of use asset was equal to the present value of the future lease payment on commencement of the lease. So basically this is the lease. So we know, like, if we have a lease liability, this liability can have a two form. One is long-term liability and one is short-term liability. So we need to show it on our balance sheet. The long-term liability will be under the non-current liability, and the short-term liability that is due within a year for the lease, it will be coming as a current liability. TCO entered into a significant contract with a supermarket chain in August 2015. The supermarket chain purchased a large quantity of goods during the September 2015 on extended credit term. The supermarket chain is expected to place another large order in October 15, and TCO has begun to store inventory to meet the demand. See, this one is very important that we have discussed. Why the inventory is going up and why the trade receivables is increased. That's the reason, because they found a big customer and they had to give some long credit term. They had to give some good offer to the customer to keep them. At the same time, to fulfill the demand of the new order, they had to buy large amount of inventory. So cash outflow for the trade receivables and for the inventory is not always bad. It could be good as well. Tico has received a letter from one of its key supplier indicating that it will cease supply if outstanding invoices are not settled on a timely basis. This is not very good because the supplier giving the warning to the company saying if you don't pay on time, we are going to cease to supply. So it's a risky for them. So of course, like increasing the trade payable is basically not a good sign for them. And for that reason, they had to pay to the supplier on time. So it's increasing the balance because before maybe they took some more time to pay to the supplier, but after getting the warning, now they had to pay on time or a bit early, and that's why it's increased the balance. So you understand the story now. Now let's look at the requirement. It's using the information above, comment on the changes in the financial position of TICO during the year end 30 September 2015. Note that you are not required to calculate any ratio. So you don't have to calculate any ratio. Just need to say what happening here, why happening, what is the reason behind. Sometimes we may need to use the word maybe because some of the answer we don't know. For example, the sales must be increased because if they enter into the new contract with the supermarket, then definitely the sales need to be increased. And for that reason, the trade receivables increase, inventory increase. We have to link it with the scenario. Let's have a look. Yesterday, statement of cash flow revealed overall healthy increase in cash 1.4 million. Now they're saying the statement of cash flow reveal a healthy overall increase. So healthy overall increase means how much is the total increase on the cash flow, and it shows 1.4 million. Now, of course, like if we looking at our financial statement, everything we're calculating based on here, and if we're looking at our what's that called? Net increase and cash equivalent is 1.4 million. We need to consider the 30. So it shows like overall increase 1.4 million. So if you're looking at this cash flow statement and you say it's a good, it's not bad, because overall, if we have operating, if we have a investing and the financing after adjusting this three, the company is not in bad situation because they have overall cash 1.4 million increase. And of course, like we have some opening balance overdraft, and because of that, we have a 850 left on the bank right now. But for this year, 1.4 million is not bad. So as a healthy, is a positive, you can say that. Then, however, T company has a net cash outflow from the operating activities and therefore is going concern status must be in doubt that we have discussed. They are saying here because the operating activities is on minus, on negative. So that's basically very risky for the company, because if the company don't have enough money or generating the negative cash flow for the operating activities, that means for the long run it will be in trouble because the company don't have enough money to run for the daily basis. So very risky for the company. Then it says to survive and thrive, business must generate cash from the operation. That's always need to be, because no one do the business to make the loss. You have to have enough working capital in the business to pay the rent, bill, and daily expenses, to pay the supplier. So every business should have this thing. But T company used cash in its operation totaling 2.78 million despite reporting an operating profit 270. Now they are saying they used in the operation 2.78 million. So 2.78 million, if we're looking at our cash used in the operation, they used in 2.78 million. And of course, like they use it because even they don't have enough money, how they use it. You see like the profit, they say they have profit only 270,000. They have a profit only 270,000, but they used 2,780. That means they used more than the profit they have. So they have only profit 270, they spent that. Where the money coming from? We know where the money coming from. The money coming from here, 4.6 million came from selling or disposal of the non-current asset. They make a profit, and also 12 million they get. And that's why they use this money. So that's they're trying to tell here. T&Co used cash in operation total 2.78 million despite reporting an operating profit 270,000. The main reason T company was able to report a profit was because of 4.6 million surplus of the disposal of the factory. So this surplus, the profit we make by selling or dispose of the factory, that's why we have been able to use this cash. Otherwise, we have only 270 profit. How I'm going to spend 2.7 million? I should not have this money. The sale of the factory appears to meet the criteria for a sale, and the leaseback transaction therefore has not been accounted for correctly. So the question tell us like, oh, they didn't record it. So we need to mention that as well, because they said here the accountant of T Co has derecognized the factory and has recorded the gain in the sale of the profit and loss. They have not accounted for the lease. So as far as it's meet the criteria for IFRS 15, we should recognize it. All right, an adjustment required to recognize the right of use asset in respect of the right return, the lease liability, and to adjust the gain on the sale of sale to reflect only the gain on the right transfer. The cash proceed would not change and are stated correctly in the statement of cash flow. The fact that transaction took place immediately before the year end and the incorrect accounting treatment implies that sale is an attempt to window dress the financial statement. Now, window dress means like you're trying to show some nice figure on the financial statement. So you're making the window dressing. Window dressing represent like you don't look at inside of the house, but you just decorate the window nicely so that people see from outside your window, they assume like everything inside is nice. The gain on right retained and the cash inflow are non-recurring transactions, which in the future will be replaced by interest expense and repayment of lease liabilities, which will have a negative impact on cash flow. However, were not for the disposal of proceeds 12 million from the sale of the factory. So if the company don't have this 12 million, they could be in trouble for sure. T company will be reporting 10.6 million net decrease. So now they have a 12 million. And for that reason, they are showing, you can see here, because of the 12 million, they have a reported, we have 1.4. But if we remove this one, if we don't have this one, if we don't sell this property this year, 12 million, so we will not have any positive. Actually, we have 10.6 million. We'll have a negative. So 12 minus 1.4, actually, like you will end up with without the making the profit of on disposal, we'll end up with the 10.6 million net decrease in cash, not positive. It will be negative. T&Co will not be able to sell the factory for cash in the coming year. So it is not possible like every year you're going to sell the property. Therefore, it seems likely that forthcoming period will see a large outflow of cash unless the T company trading position is improved. So unless their company is getting better, next year the company will be definitely shortage of cash because next year they will not be able to sell any factory again. Despite the apparent downturn in trade, T company working capital balances, inventory, trade receivables, trade people have increased in the year. So I think we understand why it's increasing, the new customer, this and that. We must consider the reason for this and the potential implication for the company in the long run. The receivables and inventory have both increased, but appear to be due to the new contract with the supermarket. The supermarket chain has offered extended credit term and the company has begun to store inventory to meet the future demand. So it's a good thing. We cannot say bad. Even the cash is outflow, we cannot say it's bad. This has a negative impact on cash in the short term, but in the long term, it will definitely make more profit because when these big supermarkets start paying to us and when you start selling the big contract, we'll make a lot of money from them. So this they are saying here. The next one, they say the income tax paid 1.3 million in relation to the previous period is high. So as we discussed before, any income tax we paid this year is relevant to the last year. This suggested that T company fall profitability has been swift and steep. So that means like if the tax paid last year 1.3 million, in this year the tax liability is only 100,000, not even million. That means the profit is reduced a lot, and because the tax is calculated based on the profit. It is important to note that a company would expect its cash flow from operation to cover its mandatory payment of interest and tax. So the company should have enough money to cover its interest and tax, because this one cannot be accrual. This one has to be paid from the bank on actual basis. T company is not in the position to do this and will need to fund this payment from other sources. So if the company don't have money right now to pay the interest and the tax, they cannot tell the bank like, I don't have any money to pay the interest, or they cannot tell the HMRC, I don't have any money to pay the tax. So they have to find different sources like overdraft or something to get some money to pay these taxes and the interest. These are some good signs though. Investment in non-current asset has continued with both cash purchase and right of use asset acquired under the lease agreement. The acquisition of asset using lease may indicate a lack of cash available to purchase asset outright and will result in future payment of interest and capital repayment, which will have a negative impact on the cash. Definitely, if we have investment in non-current asset, obviously in future will not be able to sell more. And if you buy any non-current asset, and also there is a payment for the right of use, because if I take a lease, there should be a lease payment every year. And if I start paying the lease payment, and if you don't have enough money to pay the interest and tax, so that will bring additional burden for the company for paying the lease payment. The use of lease agreement is not necessarily is a bad sign, though may be a very sensible way to acquire asset to expand the business when cash is not available. So at the same time, we have to say like taking the lease back, that means sell and lease back, is not a bad option, because if I don't have the money, but still I need the asset, this could be the very good option, because I just sell my asset, get the full money, and after that I take as a rent. So it's not bad if the company don't have money to buy the whole asset. Some of the disposal proceeds have been used to redeem expensive 4 million 10% loan which was overdraft. That we have seen here, because the loan is paid. If you remember the 10% loan, that was expensive and that is fully paid. So last year we had a loan 4,000 on the balance sheet. Now it is nil. That means we paid, and we paid by selling the non-current assets. So it's a good, because we are taking now cheaper loan that is only 6%, not 10%. So it's paid. The fact that loan repayment were overdue further suggestion that the company is not managing its cash position very well. It's finding it difficult to make payments default. Of course, like they paid the loan for the 10%, but they took another loan for the 6%. So that doesn't look like they have very good cash management, or they have enough money to pay all the loan. The repayment is a non-recurring in nature, will therefore not be required in future periods. So if the full loan is paid for this 10%, so they don't have to pay any more in future. So of course, this balance, the amount they paid is 4 million this year. Next year, they don't need this 4 million at all. The repayment, the loan seems to have been partially replaced with a smaller and cheaper loan for 800,000 for 6% loan. This will have a positive impact on the amount of interest paid, and the reason for taking the loan and the repayment terms need to be understood. So you need to know why they took this loan, how long it will take to pay. But only the good thing we can see here is 6% compared to 10%. That means next year, the interest of the loan will be a little bit lower compared to this year, because now we're paying only 6% interest, not 10% anymore. It is noted that TICO has a large liability in respect of the government grant, so some grant they have to pay it back. If TICO fails to comply with the terms and condition of the grant, so if they cannot fulfill the terms and condition of the government grant, it will become repayable, which will have negative cash flow implication. So if they cannot fulfill, they might have to pay back all the money. It is also noted that T company did not pay an ordinary dividend in this year. So we see there is no dividend paid to the shareholder, and they will not be happy if the company don't pay any dividend for 1, 2, 3, 4 years. The shareholder will sell their share, invest on the company where they get the dividend. So it's not very good sign. It is that decision was appropriate in current year given the cash outflow. However, the payment of a dividend may be expected in the future because all the shareholder will be upset if they don't get the dividend. Tea company recovery may depend on whether the circumstances causing the slump in profit can be addressed and company is able to generate an operating cash inflow in near future. The statement of cash flow has, however, highlighted some serious issue for the shareholder to discuss with the directors at annual general meetings. So all this thing we have talked, the shareholder should discuss this thing with the directors so the director can give the appropriate answer why it's happening and how to improve it, because this is the matter that they have to discuss that we have find during our all explanation. So that's how we need to interpret our cash flow statement. And in the exam, of course, like you need to know every single point. So you need to break it down. For example, when you're looking at the question, you have to break it down in few parts. For example, start from here, like non-current assets. What's happening with the non-current asset? If it's going up or down, what's the reason? Then current asset, then the equity, then the loan. You have to write for every single point that is relevant to the cash flow. And that's how you can write like the whole thing for the whole interpretation for the cash flow. And top of that, you have to add some extra line from yourself that is not here. For example, what could be the reason behind, and that will give you some marks because that will not be same for all the candidates. So for example, if you believe something, if you write that, and if I believe something, if I write that, it's not going to be same. For the examiner, he always like the unique answer. So of course, like if you feel something, that could be the possible reason. You can always include that. There is nothing wrong with that. There is no negative marking. So that means if you write the wrong sentence, you're not going to lose any marks for that. So there is no negative marking for that. So also top of that, we need to always consider the additional information. This additional information will give us more idea to write something that we don't get it from the financial statement. For example, this one we are saying the supermarket, we don't know because the sales we have only for this year. So if you look at the profit and loss account, we have only the operating profit for the current year. We have no idea about the sales for this year, last year. But when we are reading the additional information, we can see actually they have a new contract, and it make more sense why they're buying a lot of inventory, why the credit receivables or the credit customer going up. So it's look like the sales is increasing, even though it's happening at the end of the year, September 15. But very soon this money will be converted into cash because I'm selling to the new customer. Hopefully, near future the business will be better. So this thing is very important. But if you practice few times, for example, if you read this question once again, and if you try to write by yourself, maybe first time you're not going to get all, and maybe you can check your answer with the answer and try to add the point you forget or you missed. And next time, if you do 3 times the same question, you will be getting better and better. And that will start making more sense, like why you're writing this, why you're doing this, how to calculate this thing. So every question should be practiced 3 times before you ask any question, like why I'm not understanding this, why it's happening, because it will make sense when you do the same thing your time. Hopefully this information will help you to interpret your cash flow statement. And on the next session, maybe we'll try to find another topic and we'll do something else. Thank you very much for watching.